Welcome to Finbot Insights. It is a widely held belief that long-term investing is a solved problem. Today, we are going to put that assertion under the microscope.
You have likely heard the strategy. Buy a low-cost index fund, hold it patiently for decades, and you will almost certainly build wealth. But if the solution is truly that simple, why do so many individual investors fail to achieve its promised results? In this analysis, we will investigate whether the problem is truly solved or if a critical variable has been left out of the equation entirely.
Our examination will be systematic. First, we will establish the argument for why investing is considered such a straightforward path. Then, we will confront the single greatest obstacle that stands in the way. And finally, we will reveal the one factor that truly separates successful investors from everyone else. To begin, we must establish a clear definition. When we say that investing is a solved problem, what exactly does that phrase mean in this context?
The core premise is that a reliable and repeatable solution exists that works for almost anyone, regardless of their financial expertise. It implies that you, the individual investor, can achieve excellent returns using a simple strategy with a very low probability of long-term failure.
The case for this solved problem is not built on theory. It is built on a mountain of compelling historical data.
For nearly a century, the S&P 500, which represents the 500 largest companies in the United States, has delivered an average return of approximately 10% per year. This single powerful statistic is the very foundation of the entire passive buy-and-hold philosophy. The historical record is remarkably consistent. Holding a diversified basket of stocks over almost any 20-year period has proven to be a reliable path to positive returns. And now, thanks to low-cost index funds and ETFs, accessing these returns is mechanically simpler than it has ever been.
The promise, therefore, is one of nearly effortless wealth accumulation. The proponents of this strategy argue that with automated contributions, investing becomes a simple matter of setting a course and letting the engine of compound growth do all the heavy lifting for you. Now we must pivot. We are going to confront the central flaw in the solved problem thesis. Because while the historical data is perfectly clear, human behavior is anything but.
This particular sentiment captures a very common experience among retail investors, a painful divergence between elegant theory and messy reality. It suggests that the simple strategy is not quite so simple in actual practice.
The data here is not just clear, it is damning. Over a 20-year time frame, a staggering 98% of active retail traders fail to beat their own benchmark. And what is a benchmark? It is simply the average market return you would get from buying and holding a basic index fund. This reveals a catastrophic gap between the returns the market offers and the returns people actually walk away with.
These persistent behavioral biases cause investors to systematically destroy their own returns. Through a series of unforced errors driven by emotion rather than logic, they manage to turn a winning strategy into a losing game.
Modern technology has certainly democratized access to the financial markets, but in doing so, it has also created sophisticated new ways for us to sabotage ourselves.
Robo-advisors are a perfect example of this paradox. They can automatically handle complex tasks like portfolio rebalancing and tax loss harvesting, effectively delivering professional-grade management to anyone with a smartphone, all for a minimal cost. They solve the mechanical problems of investing.
Yet, despite these powerful technological aids, the core behavioral challenges remain. An algorithm can automate a process, but it cannot regulate human emotion during a market crash. In this sense, technology often treats the symptom, but it completely ignores the cause.
So now we arrive at our synthesis. The tools for success are readily available, and the historical data is highly supportive. However, the effectiveness of both hinges entirely on a single, non-automated variable.
That crucial ingredient, which no app or algorithm can provide for you, is discipline. This is the bridge that connects the market's potential returns to your actual returns.
And this brings us to the central conclusion of our analysis today. Long-term investing is not solved. It is not an automatic process that guarantees results. It is, however, solvable for any individual who understands that the true challenge is not analytical, but behavioral.
Your success is ultimately contingent upon the disciplined application of these three simple yet profoundly difficult rules. Knowing the strategy is the easy part. The execution is the real test.
And so, the final question is not about the market, the economy, or the latest technology. The final question is about you.
They advise that this analysis is for informational purposes only and does not constitute financial advice. You must conduct your own due diligence. You should not trust social media influencers, and that includes this channel, with your financial decisions.
If you found this analysis to be valuable, support our work by clicking the like and subscribe buttons. It helps ensure that we can continue to produce more data-driven content just like this.